The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and/or legal advisors before implementing any transactions and/or strategies concerning your finances. The information discussed in this presentation is current as of the date noted, is for informational purposes only, and does not intend to address the financial objectives, situation, or specific needs of any individual investor. Any information is for illustrative purposes only and is not intended to serve as investment, tax, or legal advice. Since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances, results will vary, and no suggestion is made about how any specific solution or strategy will perform in reality. And with that, just a brief overview of the things that we'll cover today. We are going to recap Q4 performance, themes, and drivers. We're going to do a brief review of 2025 market performance, geopolitical headlines, look at sector performance and valuation, and then give a quick look to Q1 and overall outlook for 2026.
So just kind of looking back at the fourth quarter of 2025, some fairly strong performance, about 2 to 3.5%, depending on which index you look at. I think one of the interesting things when we look back at the fourth quarter is, usually in most periods of strong equity returns, we see the NASDAQ leading. In this case, it was the Dow Jones. The Dow actually returned about 3.5% compared to the S&P and the NASDAQ, which returned about 2%. And that's something that we'll talk about a little bit later in the presentation, but I think it represents a bit of rotation out of some of the tech-heavy mega caps and into some different areas of the market, which I think is a good sign. But again, we'll talk about that later in the presentation. But we can jump to the next slide, Ryan. So some of the key themes and drivers from the fourth quarter, I think the biggest one was obviously just continued resilience. There's been a lot of talk over the past, year or two about maybe some cracks in the labor market, but we've seen pretty robust spending, and the consumer seems to remain pretty resilient, especially amid increasing risks and macro uncertainty. Obviously, there's a lot of political uncertainty right now, but despite all of that, the consumer kept spending and remained pretty strong for most of 2025 in the fourth quarter, especially, for a strong holiday spending season. And then on the corporate side, obviously a good amount of uncertainty there as well. But, the main thing or main story there is just that earnings remain strong. So I think positives there in terms of resilience. The other theme for 2025, especially for Q4, is that the AI trade remains pretty central. But I do think that investors are becoming a bit more discerning. We talked about how the Dow had a stronger, return than the S&P and the NASDAQ in the fourth quarter. And I think, this is part of it. We saw modest gains for tech and kind of the broader market, but we also saw a bit of cooling relative to the first three quarters. We had a lot of volatility in the first three quarters and also some strong price action. Q4 represented a bit cooler interest in the market. We didn't really see a Santa Claus rally like we thought we would. But still pretty strong performance given all of that. While tech performance cooled a bit, other areas of the market, you think about value and small cap, saw some renewed interest. So I think we saw some rotation into those. We saw prices for small caps take off towards the end of the year, and especially, the beginning of 2026 saw some pretty intense price action. So I think some rotation out of tech is a good sign there. And then kind of the key theme for all of 2025 is, international equities outperformed, U.S. equities. Kind of the first time in, I'd say, roughly 15 years that this is the case. Again, just another signal of kind of rotation out of U.S. mega caps, kind of investors looking for different avenues to invest their money. And we can jump to the next slide, Ryan. Just to keep going here, interest rate cuts were a big theme for all of 2025, but especially Q4. We saw the Fed cut rates twice in the fourth quarter, and that I think helps to boost equities in the short term, but also the long run. These decisions within the Fed haven't been as unanimous as earlier cuts. Early in the year, we saw the first cut was pretty unanimous, but there's a bit of dissenting opinion going forward in terms of inflation, in terms of the state of the labor market, and where rates need to be. So it represents a bit of a different theme in the fourth quarter. Another big story in terms of interest rates is obviously Trump versus Powell. The president is calling for lower interest rates, and Jerome Powell, who's the chair of the Fed, is kind of seeking to keep independence from the administration. And that kind of complicates stuff going forward. Powell's term as Fed chair actually ends in May. So the new chair is going to be picked by Trump. You would expect that the new chair is going to be very sympathetic to Trump's calls for lower rates. So that could create a different dynamic going forward and something to kind of monitor in 2026. We can jump to the next one. Thank you. So some of the key performance drivers in 2025, obviously tech and AI leadership is kind of the big one. So we think about a few things. We talk about that. I think the first is the AI spending cycle. If you think about data centers, GPUs, cloud spending, that really remains strong and a strong growth driver for not only tech, but kind of everything that branches out off of tech. It continued to benefit semiconductors, cloud providers. You think of power and energy names, all kind of benefited from that sustained heightened level of AI infrastructure spending. Another point there is the AI-related productivity narrative. So this is just kind of the idea that AI should continue to increase productivity, drive margin expansion, and help to support higher relative valuations. And that's really one of the central themes of kind of this market rally that we've seen over the last 3 years, and that kind of pushed markets as well in the fourth quarter. And then again, one of the big things I think for the fourth quarter in terms of tech and AI is that we're seeing AI branch out beyond tech. You think of non-tech companies like industrials, healthcares, financials, some consumer names. There are companies in these sectors that have pretty credible AI-driven stories that have seen strong performance as well, and that kind of strengthens the AI narrative. It's not just tech; we're seeing some broadening into other sectors, which I think breadth is always good there. And then in terms of tech and AI, just general optimism. The risk on mood and positive sentiment surrounding AI has really helped to kind of offset some concerns that investors and consumers might have in other areas. We're in what's hopefully a rate cutting environment, but obviously we're experiencing higher rates than we really have seen over the past 15 years. Like we talked about, there's increasing geopolitical risk, increasing volatility, relatively sticky inflation, and also the labor market that potentially could be showing some cracks. So a lot of things for investors to worry about, but the general AI optimism, AI theme kind of helped smooth those over in the fourth quarter. Another performance driver for the fourth quarter, interest rates, obviously, the continuation of the easing cycle that we've seen towards the end of the year. So we got 2 further rate cuts in the fourth quarter, and that kind of validated, expectations of a rate cutting cycle from the market. The market was pricing in a number of cuts, and I think they were happy to kind of see 3 cuts towards the end of the year last year. Fourth quarter performance was at least partially driven by these lower rates, rather than solely posting, extraordinary earnings beats from companies. But I think that the rates definitely did help to boost performance a bit. Like we talked about, small cap stocks posted strong performance as well, and obviously, lower rates are very beneficial to some of the smaller companies who, that large borrowing cost can really eat into their margins. And then also on interest rate cuts, I think the cuts just also helping to improve the odds of a soft landing where we see inflation kind of slowly come down over time without facing that kind of economic decline that the market had been worrying about. So I think that boosted equities as well. Rotation and market breadth, like we've talked about, just seeing a broader contribution to the market in the fourth quarter than we have for previous quarters. So like I said, it wasn't just tech. We were seeing contributions from small caps, and from different sectors that aren't just tech. You think utilities and healthcare and things like that. Again, we saw strong performance from industrials, from financials, from consumer names. So I think all good news there in terms of kind of branching out, rather than kind of leaving that risk just on the financial sector. Earnings growth again was pretty broad based in terms of earnings participation, not just tech, but again coming from other sectors as well. We saw really strong forward-looking guidance that helped to calm some jitters in the market, particularly related to AI, and kind of reinforce some confidence in the near term there. And then commodities, one of the biggest stories of 2025, and especially the fourth quarter, is gold and silver. The high levels of geopolitical risk, uncertainty, really sustained demand for gold and silver as safe haven assets. Softer USD also kind of helped support the precious metal prices as well. But we saw the price of gold rise over 11% for the quarter, but silver was up almost 50% over the same time period. So a lot of price action there. And then the other commodity is Bitcoin. Bitcoin dropped about 20% in the fourth quarter. Likely a result of some profit taking as we kind of enter what appears to be a rate cutting cycle. And broadening equity performance, I think, also probably hurt Bitcoin as well, as people rotated some money out of Bitcoin, maybe took some profits and moved that into equities. But we can move to the next slide. So kind of looking back at 2025 as a whole, we can look at the returns, but also want to look at a few of the kind of stories that affected markets. But again, another strong year. It's not typical that we get this sequence or this long of a bull run. I think the last 2 years before this have been plus 20% returns on the S&P, and obviously very strong returns for the market in 2025 as well. So you're looking at 16% on the S&P, 20% on the Nasdaq, about 13% on the Dow there. But if we move into kind of looking more holistically back at 2025, what are the kind of stories that affected the market? So we think back all the way to January. And Trump was inaugurated for a second term. He would go on to make several sweeping changes in 2025. Most notably, at least for the markets, would be the weakening of regulatory agencies like the SEC, really laxing regulations surrounding cryptocurrencies like Bitcoin, and then the establishment of Doge in an attempt to cut government spending, really slash government jobs and government spending. That was actually disbanded in November. But if we move on to April, one of the biggest stories for markets in 2025 was obviously the Liberation Day tariffs. At the beginning of April, Trump implemented a 10% baseline tariffs on all imports into the U.S., as well as additional reciprocal tariffs on specific countries that had pretty large trade imbalances with the United States. At the beginning of April, their markets dropped over 10% as a result, only for a majority of the tariffs to be paused to allow countries to come to trade deals. As a result, we saw markets come back pretty quickly to where they were pre-tariffs. If we move on to July, we saw the One Big Beautiful Bill Act was signed into law. It included sweeping cuts to government programs like Medicaid, SNAP, federal student loans, as well as massive tax breaks. So the bill actually extended many of the provisions that were included in the Tax Cuts and Jobs Act. And it's estimated that the bill will add more than $4 trillion to the deficit over the next 10 years as a result of the cuts and increased spending. Moving on to September, we got our first rate cut for 2025. Like we talked about, the Fed would cut rates twice more in 2025 in October and December. Kind of amid some cracks showing in the labor market and sticky inflation. Not inflation that we saw was rising, but definitely hovering, in the high 2s to 3 range, kind of above the Fed's 2% target, which is kind of what prompted the Fed to cut rates there in September, and then obviously continue to cut as we moved on for the rest of the year. As we move into October, we saw the longest government shutdown in U.S. history begin, as the Senate kind of failed to pass appropriations legislation, with lawmakers failing to find a compromise on expiring Affordable Care Act subsidies. The government shutdown ultimately lasted 43 days, but no agreement on healthcare subsidies was reached, and they ultimately expired at the end of the year. So as we move into kind of talking about the market themes for 2025, the Mag 7, drove another pretty strong year for the markets. The Mag 7 accounted for roughly 42% of the total return of the S&P 500, despite only making up 1/3 of the index weight. Obviously continued optimism on AI and tech helped to fuel market optimism and kind of push prices higher and higher. And as markets make new all-time highs, some investors are becoming a bit wary of stretched valuations, with PE multiples for the Mag 7 trading at considerably higher than the broader market. A note there is, I think interestingly, only 2 of the Mag 7 companies outperformed the S&P last year. That was NVIDIA and Google. So it was a strong year for the Mag 7, a strong year for the market. But I think it just speaks to the broadening of the market that we talked about a little earlier, that more outside companies, outside of tech, outside of the Mag 7 are helping to drive the market than we saw in the previous 2 years. So just looking at some sector performance, no surprise that communication services led the way. Obviously, with the Max 7 being comprised heavily of tech, we saw a 32% return there. But like we talked about, some of the broadening, we saw financials, materials, industrials, utilities, all have really strong years, posting returns over 20%. And actually, all sectors posted positive returns. Real estate was the laggard, posting 6.5%, but no sector posted a negative return in 2025. So as we talk about consumer confidence in 2025 in the fourth quarter, it slipped to multi-month and even multi-year lows during 2025. And this was just amid, high levels of uncertainty surrounding the labor market, inflation, government policy. Consumers' expectations about future economic prospects dropped pretty significantly in 2025. Towards the year, we did see slight periods of improvement, but overall confidence levels remained pretty subdued relative to what we've seen the previous year and also kind of what's average over the history that we've been measuring this. Another note there is just that, one thing that we have seen is confidence really diverged by income level. We saw higher income households more insulated from the elevated rates and prices, with lower income consumers kind of feeling that pressure more than the high income households. And this is just some evidence of a K-shaped economy that, some economists suggest is really playing out with, wealthy individuals and those with significant stock ownership really flourishing, while lower individuals and lower income families kind of feel the effects of inflation and kind of a weakening job market. They're not really, experiencing the same realities as wealthier households. If we look at consumer spending in 2025, spending showed relatively mixed signals, with overall growth slowing from what we saw in 2024. But again, still remains fairly resilient, and that's one of the themes that we talked about at the beginning of the presentation. Q4 spending was bolstered by a pretty strong holiday season this year, though many consumers seem to have paused on higher ticket purchases amid elevated rates and a generally more cautious sentiment. But this kind of showed us spending on goods like cars, appliances, electronics generally slowed, while spending on services really increased. So if you think dining, travel, entertainment, those remained relatively strong there. Consumer spending was mostly driven by high income earners, like we talked about, kind of the emergence of that K-shaped economy, whereas lower and middle income consumers cut back more after kind of feeling the effects of tariffs and that economic uncertainty. 2025 highlighted, what I talked about, that many are calling a K-shaped economy, where high-income earners kind of spend more, while others face pressures that cause them to either cut back or kind of dip into savings for essentials, with spending shifting towards value rather than premium options. If we move on to inflation, so talking about CPI and PCE inflation, in 2025, U.S. inflation remained relatively sticky, generally hovering around 2.7 to 3%, slightly above the Fed's 2% target. Inflation was largely driven by strong consumer demand. Housing costs played a big part, and tariffs were also inflationary a bit in there as well. Whilst inflation is still above its target, it's been on a fairly slow and steady path downwards towards that 2% target that we're talking about, since the highs that we saw in 2022. As such, it seems like the Fed has placed a greater emphasis on the labor market when making interest rate decisions. So it's kind of expected that inflation will come down, at least from the Fed's perspective, or that it won't, take off. But that's what's largely influenced the series of cuts that we saw to end 2025, was kind of that labor market weakness, but inflation kind of staying relatively where it was or inching downwards that we've seen since 2022. And just a graph on year-over-year CPI index from December 2025, you can see that, food kind of drove a little bit of increase there. Obviously, energy was a little bit below all items, but averaged out, we're sitting just at about 2.7 to 3% on inflation, which again, we want to be down at 2%, but the progress that we've made since 2022 is promising. So as long as we continue to see, slow, steady progress, I think that the labor market should be the focus going forward for the Fed. And talking about the labor market, in 2025, the labor market experienced a pretty significant slowdown in job growth. The U.S. Labor market only produced 584 jobs added. That's an average of about 50K a month. And that's the weakest pace actually outside of a recession in the last 2 decades. And part of that was driven by reduced immigration and also slower demand. The unemployment rate remained relatively low, around 4.4%, partially just because of a shrinking workforce, kind of helped to keep demand for jobs stable. Some of the job gains that we saw were concentrated in healthcare, while manufacturing and government jobs obviously saw the biggest decline there. This is really the continuation of what we've been calling the low hire, low fire job market that we've seen for the past year or two. Just kind of reflects some of the macro volatility that we saw in 2025, as many employers kind of chose to slow or really pause hiring until we got a clear view on policy, the economy, the labor market, things like that. But with inflation hovering or trending downward right now, or at least right above the Fed's 2% target, many economists, I think, are going to be looking towards the labor market this year when we think about future rate cuts. And just looking at, like I said, payroll ads over the last 2 years, you can obviously see that there's a lot more payroll ads in 2024. And as we get into 2025, that kind of subdues a bit. And even in October, that went negative, obviously influenced by the government shutdown there in October. But you can see the hiring kind of declined once we got into 2025. And I think just a reflection of kind of the uncertainty faced by employers and those hiring, that there may be kind of a wait and see attitude, but again, just further contributing to the low hire, low fire job market that we've seen. So when we talk about the Fed and interest rates, like we said, the Fed cut rates 3 times in 2025, twice in the fourth quarter, reducing the federal funds rate by 75 basis points. So we ended the year with a target range of 3.5 to 3.75%. The cuts were aimed at boosting employment, as, like I talked about, the labor market showed some signs of cooling, even as relatively stagnant inflation remained a slight concern. Analysts and economists are expecting roughly 2 cuts in 2026. But like we talked about at the beginning, Jerome Powell's term as Fed chair is up in May, and obviously the next chair is likely to be very sympathetic to Trump's calls for lower rates. So once we get to May, how independent the Fed is going to be once Powell leaves is going to be a big story for the rest of 2026 and should kind of drive those interest rate assumptions going forward from there. Looking at GDP, real GDP increased at 4.4% for the third quarter of 2025. We don't yet have the fourth quarter estimates out yet, but that's according to the BEA. We saw in the second quarter, real GDP increased 3.8%. The increase for the third quarter was largely driven by increases in consumer spending, but also helped with exports and government spending, as well as a decrease in imports there. The fourth quarter estimate or advanced estimate for GDP was originally set for the 29th, so 2 days from now, but that's been rescheduled by the BEA to late February, just with some collection issues and some delays from the government shutdown that we saw in October. So looking ahead into 2026, a few things to touch on. What are kind of the investment themes to think about for the year ahead? And there's a few that I do want to touch on. Interest rates obviously being one of those. We talked about how traders seem to be pricing in roughly 2 cuts for 2026. Would expect that these be predicated by either continued progress on inflation towards 2% target, along with stable or strengthening labor market conditions there. I think lower rates would expect it to be continued to boost equities, but given that the market is expecting 2 cuts this year, a failure to cut or even an increase in rates would likely see equity prices as well as fixed income prices come under pressure. And like we just talked about, there's also that added dynamic for interest rates of a new Fed chair in May who will be picked by Trump. After May, it's a bit of a mixed bag in terms of what we might see. So that adds to the uncertainty going forward into the second half of the year. Another theme to talk about, and one that we talked about for 2025, is just the resilient consumer. We talked about how the consumer remained resilient in 2025 amid a pretty good deal of uncertainty. I don't expect that uncertainty to go anywhere in 2026. But one thing that I'll be looking at as the year goes on are, consumer confidence levels, consumer spending levels, How do consumers feel about their economic situation? How is that affecting their actions? I think that will really be important to look for in 2026. Another theme and one that we talked about for the fourth quarter of 2025 is just market rotation and, kind of breadth of the market. We've already seen some of this to kind of end 2025 and start 2026. But can the market rely less on the Mag 7 that it has in the past to drive that return? If we can open that up a bit in terms of, industry, cap size, growth versus value, I think that can go a long way to kind of mitigating some of the risks that might be inherent in, those top 7 mega caps making up such a large percent of, our market. And then obviously another big theme that's played out over the last 2 to 3 years that, I expect to play out in 2026 is just the AI trade. And that kind of moves us into our next point. Some things to kind of think about in 2026 as it relates to AI. We've seen pretty significant CapEx spend in the AI space. And I think that'll be key in 2026, but I also think that, it'll be pretty highly scrutinized. The top companies in the space have really invested billions and billions of dollars to build out the AI infrastructures and models. But how companies continue to spend on AI will really signal their intent and kind of their confidence in terms of that this is a winning bet for them. And I think the market will kind of react accordingly to that spend. Also at some point, I think these AI companies are also going to need to start seeing a return on their AI investments. And that's ultimately going to be dictated by the market. Will investors get antsy if we don't see progress towards profitable AI in 2026? It's something that we'll have to keep an eye on this year. Another question that we kind of have to ask ourselves in terms of the future of AI or the AI trade in markets is, at what point do we kind of move out of this AI infrastructure build out phase that we've seen and more into adoption, integration, and application? We've seen a lot of infrastructure, a lot of hyperscaling, energy and power stocks really benefited from this phase of AI. But at what point are we going to see, the shift into tangible products, for industries that help to drive efficiencies that we talked about earlier? And that just kind of leads into the next point, which is how do we see AI showing up outside of the tech sector? We've seen a lot of breadth this year in terms of moving outside of tech. One thing to keep an eye on going into 2026 is, does that continue to shift into other industries? Do the benefits move from just tech to other areas? I think that's an important theme in terms of the AI trade to look for in the next year. Another one in terms of 2026, the geopolitical uncertainty is going to remain. 2025 was a busy year on the geopolitical front, and I wouldn't expect that to slow down in 2026 as the administration tries to accomplish some of their agenda items before midterms. We saw how, in 2025, that can kind of lead to a bit of a roller coaster ride for stocks with the tariffs that we saw. And we've already seen that at the start of this year with some of the geopolitical things going on with Venezuela and Greenland. But I wouldn't expect that uncertainty and that type of risk go away this year. So I'd definitely brace for, continued volatility on that front. In terms of the labor market and inflation, we kind of already touched on this, so I won't go too in depth. But again, kind of the main points here is we have roughly 2 cuts priced in for 2026. The labor market seems to be the main focus right now, with inflation pretty steady and slowly coming down to that 2% target. But again, once Jerome Powell's term as Fed chair is up in May, we're not really sure what we're going to get after that. If we begin rapidly cutting rates at the second half of the year, we could see a resurgence of inflation if the inflation and labor market data don't back up those cuts. So again, after May, there's a good deal of uncertainty there in terms of what we might see, and that'll be a pretty driving force for the markets in the second half of 2026. And then just in terms of economists and analyst forecasts for 2026, I think most analysts are expecting that AI will remain the central theme for markets. Again, further geopolitical volatility is expected, but the continued strength of the AI trade, a rate cutting cycle and low rate environment, business friendly regulation, I think should all help to benefit asset prices there. Many analysts are predicting a roughly 8 to 10% return this year on the S&P. And that's roughly the S&P's historical return. But one thing to note there is, very rarely does the S&P actually return its average. So very rarely does it have years that it does 8 or 10%. There's usually more volatility involved in that. So, some years you'll see strong positives, other years you'll see strong negatives. Either way, there's a lot to look forward to this year in the markets, and I think it'll definitely be kind of interesting to see how this all plays out and what things look like when we kind of revisit in the beginning of 2027.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.